Joe is going to be doing the first Yummy Crypto Discord AMA, and he will be answering community submitted questions about blockchain technologies. We will go through about 15 questions, and then if we have time at the end, obviously depending on how long the answers are per question, we may take live questions where you can use the raise your hand function and we will answer live questions. But we will double check that at the end and see if we have time. But we will definitely be using Discord more for, shills, giveaways, events, AMAs, etc. So if you have any suggestions, feel free to PM me. I'm currently sort of administrating and handling everything over here on the Discord. But Joel, I'll pass it to you, and if you want to get started with the questions, we'll get going.
Thanks, Al. Can you hear me okay, Al? I think everybody can hear me fine. So guys, first off, thank you for attending. This is the first ever Discord AMA that we have for the Yummy Crypto server. This also signifies like a new era where we're going to start focusing a lot more attention in the Discord server. Like we grew so quickly to 20,000 users, a wide variety of strategies to a point that we just grew too fast. And this is part of our strategy to now start focusing more on what the purpose of this server is, which is to support the Yummy Crypto project. For those of you who haven't heard what Yummy Crypto is about, we started off as a charity-centric organization that we donate to a wide range of causes. And over time, we've donated to a whole host of entities, and we have a lot of the live streams with celebrities doing those donations like Sir Kenny, Jimmy Carragher, Kevin Peterson, just to name a few. You can go on our YouTube channel and to see a little bit more details about those as well. But one thing we believe a lot in Yummy is also about education and teaching people about all things regarding with blockchain and crypto. So that is the main purpose of these AMAs. And we submitted a Google form for people to put questions on. We got about 30 different questions, selected about 15 that we're going to cover that I feel could be the ones to help people the most. And you can also check out our YouTube for a few more training videos and tutorial videos about any aspects of blockchain. So I'm going to start with one question, which is pretty generic. Someone asked, what is a blockchain application? Well, blockchain application is essentially an application that requires you to pay to run a portion of that code, or what we will call a contract. The reason why we call a contract is because you essentially ask a decentralized entity to run a piece of code and you pay for that activity. So the benefits that has of you paying for the activity to be done is it comes with a sort of safety that it was actually concluded and it was actually recorded and the activity was completed and it's shared across a decentralized network. So that removes the whole permission aspect of the system where if I'm asking a computer to run something, I give them an incentive to run that piece of code. So I know it's going to be like executed and everybody can check it was indeed executed. That's the whole revolutionary aspect of the blockchain, is to get this decentralized computing that you have to pay for it, but it can be validated with no issues on trust. So it removes the whole aspect of how do I know this is going to get done? Well, it is going to get done and nobody can really stop it. So essentially that's the underpinning of a blockchain application. Another part that people ask me about, second question, is futures, options market, crypto markets in general. How exactly does the future market and the spot market, which is a regular market that most people buy and sell Bitcoin and other things on, how do the futures and options impact those markets? Well, it becomes an example that you can already see in the stock market, that the futures market is essentially a bet on the price movement of a particular security. And you can do this with anything in the stock market. You can do it with coffee beans, with orange juice, with bacon, like all kinds of things. You can say, I think bacon prices are going to rise 20% within 6 months. So you can buy an option that will make you profit from that prediction. And usually if you're correct, you make multiple amounts of whatever capital you invested in. If you're wrong, you usually lose everything, or at least a huge significant, like 80 or 90% of your capital. What's interesting about options and futures is they eventually, in mature markets, they start being so big that the futures and the option market can actually be bigger than the spot market itself. In the case of the stock market or of a lot of other securities, the option market is already far bigger than the regular market. And in crypto, especially in the last 2 years, or even mostly in the last year, this has also started to happen in crypto, where the options market is growing so quickly that it's starting to be as big as the actual spot market. So what does this mean? What it means is the option market actually is the main driver, or one of the main drivers right now for Bitcoin and Ethereum and BNB demand. Because it works like this. If the market as a whole is bullish and everybody buys Bitcoin options like, calls or future contracts that assume that Bitcoin is going to go up, that's going to force market makers like exchanges or people providing those future services to actually buy Bitcoin and store it to meet those contracts if they ever get executed. So if you have a lot of people starting to buy Bitcoin options, it can actually start to move the spot price of Bitcoin, because exchanges will start buying Bitcoin to secure those contracts, to make sure that they can do the paybacks. And if you do this enough, you can get to a point like we did a few months ago before the crash, where 40 to 50% of all Bitcoin demand was option contracts, well, market makers buying them to satisfy those collaterals. So this is exactly what it can happen. So what this means is you can never really get a strong bull market with strong underlying demand for Bitcoin if the options market is decimated. And that's exactly what's happening now. The options market has contracted quite a bit. A few weeks ago, it contracted some 80 to 90% of what it was like 6 months ago. Now it's finally starting to recover a little bit because of Bitcoin starting to gain some movement, but it's still nothing compared to what it was months ago. And how can you check this? That's another thing people ask me. Well, you can go on CoinMarketCap and you can look at the various exchanges and you can see their spot volume on various coins, and you can see their futures volume as well for Binance, for Kraken, for all the guys who are engaged in that. And you can even go to the pairs themselves and you can see what's called the open interest, which is essentially the number of open positions in the futures contract. And if you trace those numbers and you can track them, that's how you kind of have a feel for the amount, for the sizing of the futures contract. So that's essentially how they can play. Our futures contract can play with the whole spot pricing for Bitcoin, and specifically for like the larger coins, which then cascades to everybody else through the use of liquidations. And that gets to another question, which is, what are liquidations that everybody talks about? Well, liquidations is basically, if you have Bitcoin, you can go on a decentralized lending platform like Venus or Aave or anything of the sort, and you can lend that token and then borrow another token against the one you just lent. So if I have $100,000 in Bitcoin, I can lend $100,000 in Bitcoin, and I get paid interest for that. And I can borrow against what I just lent. Usually threshold is like 60%. So if I lent 100K, I can borrow 60,000, which then I can use to do anything I want. So obviously, if you're doing this all perfectly, you're lending 100K Bitcoin, you're getting like 5 or 6% interest on that. And then you take 60,000, let's say in USDT, in Tether or something of the sort, and then you can put that on a farm or something like that and get further yield, right? So essentially you have $160,000 working for you and you're getting that yield. Now the problem is your collateral, which is Bitcoin, $100,000, and the algorithms behind the decentralized lending want you to keep a certain ratio of collateral to the amount that you borrowed. So that 60%, let's say the Bitcoin crashes 10 or 20%. Now your 100K is worth 80,000, but you still borrowed 60,000. So now it's 80 to 60. You're below the threshold of 60, or you're above the threshold of 60%, which means a liquidation bot can look into your account and say, this guy is above his threshold, so you can get liquidated. What does that mean? It means essentially that they're going to sell your collateral piece to essentially pay back what you owe, which is a 60,000, then give you back the difference minus a fee that you receive. The problem of this is all done computationally. So what that means is when the market really tanks, like let's say Bitcoin loses 10% in a day, a lot of people find themselves in that position where they are going to get liquidated. And sometimes it can happen with such fervor and such intensity that, they take the Bitcoin, they sell it in the market, that causes a liquidation, then there's another liquidation that gets caused by that price dump, and it just keeps going on and on and on. It becomes a snowball, and that's how you can get moves of minus 20% that seem so intense, but then they accelerate like crazy and they become like minus 30% like we had a few weeks ago, it's when collaterals and liquidations are just happening non-stop. And that's a lot of times what can move the market in times like those. Now, of course, after you do that, the amount of money that is being borrowed and lent and in collateral reduces significantly. Like Venus, for example, in the day that we had a 30% BNB crash, they lost about like almost 50% of their like total value locked in the platform, decreased by about 50% because there were so many liquidations. And that's essentially how liquidations can move the market when they get enacted. And that's how you can avoid it, is by making sure you never borrow. If you, for example, if you lent out USDT, which is a stable coin, 100K, and then you borrowed, let's say, 50,000 of another stable coin, or even 60,000, you never get liquidated because the stable coins don't change in price at all. So you can technically have $160,000 of stable coins working for you with very little risk of liquidation because they don't change in value all that much. Now, another thing that people also ask me, and now we're going to flip a little bit more into Yummy specifically, is, what is it about Yummy Tokenomics that makes it so appealing? Like, Yummy belongs to a class of coins called the reflect tokens, which simply by holding the coin without not doing anything, you get a percentage of all trading fees that come with the coin just by holding it, and you get it straight in your wallet. So in case of Yummy, 3% of all transaction fees, or of all transactions that happen, 3% get distributed to holders. An additional 3% goes into liquidity, and an additional 3% goes into a wallet, which could be used for charity funding or for other applications or for other utility. The advantage of reflect tokens is that you can receive these rewards without having to do anything. You don't have to stake them anywhere. You don't have to put them in any contract. You don't have to do anything. They stay in your wallet. While if I'm doing something like, for example, Cake or some sort of staking contract, I have to put my tokens in their contract, and there's a certain degree of confidence that is involved in that because there is going to be a token transfer. Now, of course, a platform like Cake and others of similar size are never going to do anything with your funds because they already know. They're like a huge entity making a lot of money through all normal means. They have no reason to essentially exploit you or trying to rug you from your funds. But in the case of reflect tokens, that's less probable to happen because you don't have to allocate them to any contract. Of course, there's other potential exploits that can happen in other contracts, not with ours, because Yummy has a lot of things to prevent rug pulls from happening, but it certainly decreases that probability. And the other advantage of reflect tokens is that they can operate with the contract being essentially renounced, so nobody owning it, and essentially becomes this computer that runs code, runs the contract, nobody can stop it, and it's a known quantity. It's always going to operate like that, and it's truly something that can be managed by the community of how it gets interacted because nobody can ever change the code. Obviously, there comes with some other disadvantages that if you want to do some sort of changes, that you're going to have to upgrade your contract through other means instead of just changing it like you would with a regular contract. But it also brings a lot of advantages, particularly at the beginning, when it comes to the confidence level on the team. When you have a renounced contract, the team can't do anything to essentially change the code. So it reduces the amount of exploits quite a bit. In the case of Yummy, we have a lot of really attractive tokenomics because we have that 9% tax when you buy or sell, 3% going into holders. The burn address controls almost 35% of all tokens. The team also has very little amount of tokens. We have maybe 3% total. And the entire liquidity of the project, which is very, very good. Like the market cap of the project right now is about 6.5 million or 7 million. And the liquidity is 1.1 million. So essentially you have a ratio of about 15%, which is like excellent liquidity. Any project that has 5% liquidity or more is considered very good. And what that means is, and we get into another question of what exactly liquidity is. Liquidity is how much you move your price of a project by buying or selling a known amount relative to the market cap. So it's very, very important that you have a project that has at least 5% liquidity to market cap. So if it's a $1 million project, you want to see at least $50,000 in liquidity. If it's a $10 million project, you want to see at the very least $500,000 in liquidity, because that allows you to buy and sell into the project with limited impact. If you think about an extreme case, they have a project, let's say, worth 10 million market cap, right? And market cap is what everybody looks at. Nobody ever looks at anything else. They just look at market cap. And you have 10 million market cap, but the liquidity, let's say it's $10,000. Okay. That's like horrible, horrible liquidity. That's not even 1%. It's like 0.1%. What that means is if I buy $1,000 of that token in the $10,000 liquidity, I'm going to move the price by about 10%. So that means I spend $10,000, but then the market cap in quotes moves 1 million, right? So someone just put $10,000 in the system and moved the perceived market cap by 1 million, which is insane value. And the opposite is also true. If someone sells $1,000, they're going to cause a price drop of 1 million in the market cap. And why is this such a staple, like low liquidity? Why is that such a staple of pump and dumps? The reason is very simple. If you buy a project really early on and the liquidity is shit, you paid $1,000, you bumped the price like 10%, someone else did the same, someone bought 5,000, whatever, price went up 10 or 20 times, right? But the liquidity remains very low. Then you already made 20 times your money, or at least you think you did. You spent 10%, to get in. But now you're looking like, you spent $1,000 and then you got like $900 worth of tokens. And now you're looking to like $15,000 worth of gains and you're thinking about exit. But then when you go and see to sell those $15,000, you're actually causing a price impact of like 15% or something like that. So you decide not to sell because you're like, I don't want to lose another 15% to sell or cause the price to drop that much. So you're just kind of waiting and see what happens to the price, or hoping that the liquidity gets higher or that the price goes even higher before you exit. So there's that decision point where you're just waiting and see what happens because you don't want to exit with so much price impact because, again, the liquidity is really bad. But while you're doing this waiting game, 1,000 other people or more are doing the same game with you if they bought it at the same stage. And then it becomes a game of chicken. It becomes a game of who decides to sell first. And then the moment you have a big sale of $10,000, something like that, crashes the price, then everybody is like, oh, damn, I need to start selling this. And then everybody starts selling, and that's when you start having the dump. Now, if you had mechanisms in place that the liquidity would be improved as the price goes up, you spent 10% price impact to get in, but then you wouldn't spend 10% price impact to get out if the liquidity improves over time as the price improves. And that is the hallmark of a good project. A good project is one that not only the market cap increases, but the liquidity increases in some fraction with it as well, to the point it's always around 5 to 6% of market cap. And that's essentially how liquidity pools work. If you have a project that has very high market cap, but very low liquidity, it's a complete mirage. It's an illusion. Like, you're not going to be able to make money out of it because you're going to pay a lot of money to get in and you're going to pay a lot of money to get out. So you're banking on a 50 to 100% move to break even, basically. And a crash or a dump can come at any time. So essentially, it's no different than gambling. And a lot of times that's what people want, but just be aware that that's exactly what it can happen. Now, another question I get a lot when it comes to small projects and everything is, what is the best time to invest in a volatile coin like you have with microcaps and such? First off, if you have a very low liquidity coin, like I said, it's very, very hard to time a good investment, especially if you're doing anything sizable. If you're doing $10 or $20, of course, that's different. If you're doing $10,000 or $20,000, there's just no way you're going to go in without moving the price quite a lot. I personally never put any amount of money into anything that I'm going to move the liquidity pool more than 5%. That's kind of my limit. So if the liquidity pool is $1 million, the most I would ever put would be about $50,000. So that would be adjusted. Simply because if I pay 5% to enter and 5% to exit, that's already a 10% loss I'm willing to get. And that's already a project with very good liquidity. 1 million liquidity is already pretty good for the majority of the projects. The best thing with volatile tokens and microcaps is you dollar cost average. Never have a single buy at a single price point. Usually what you should do is saying, okay, I'm going to buy some today, but I'm going to have 2 or 3 other price points, lower price points in case it continues to dump, or I'm going to have 3 higher price points if it starts to rise. So you need to be disciplined about that. You need to say, I'm buying now at 10, and then I'm buying again at 7, I'm buying again at 5, and I'll make my last buy at 3. And the same way I can say I'm buying at 10, and then I'm buying at 12, at 14, and I'll make my last buy at 16. That's how you need to approach volatile coins, instead of like seeing like a single dip or something like that, unless it's of course a really extreme dip and you feel very strongly that you should buy. You should always focus on price points and have 3 or 4 entry points instead of just having one particular one and hoping that you're actually getting the all-time low, very close to all-time low. That almost never happens. So that's the strategy. Dollar cost averaging is the best way to go with a smaller coin. Now, another question to switch gears a little bit. What is proof of stake versus proof of work? And this is a little bit more conceptually, like it's more of a notion than an actual thing regarding with the crypto markets. At the end of the day, those two are the validation mechanism of how the transaction is actually validated. And proof of work can be seen by the following. Like, let's say you belong to an organization of sculptors, okay? You guys make statues. And when someone shows up and saying that they have a statue that's worth money, you assess the value of that statue, or you assess the proof of his statement by looking at the statue. So you look at the statue itself, and if you're a sculptor yourself, you can tell it's complicated, it took time, it took effort. You don't know the exact details of every single thing he did, and most likely you cannot go back to the original block of stone that was used. Like if he asked you, look at the statue, can you tell me what was the original block of stone? No, you can't do that. But you can tell that there was a lot of work from that block of stone to the statue itself. That's the proof of work. The proof of work of the guy saying that this has some value is because indeed you can say, well, he spent some time there. I can see some of the mechanisms he did. Not everything. I don't know exactly how he got to this final stage, but he obviously did some work, right? So that's the proof of work. And you can apply this to a concept like building anything. Except this is for a transaction hash. So when you take a transaction hash that went through one of the security scripts, like SRA, whatever it is, the industry standard now, it can be validated through the transaction hash that indeed the work was done to achieve it from a transaction that was submitted that we don't know all the exact details of what the keys were used, but we can see the final product. So that's a proof of work. And that's how Bitcoin works. That's how Ethereum works. That's how a lot of the first generation coins work, is doing proof of work, which is also known as mining, which is then used as the validation for the transaction. Proof of stake came up afterwards. I think the first platform to have it was the Next. NXT was the first coin I think that had proof of stake. And proof of stake works differently. So instead of you having a sculptor coming up with some work that he did, instead what you actually have is you have someone who is a wealthy individual of that currency, of that asset, and he's saying, this information is real, and I am betting a significant portion of my net worth that it is real. And if it's found to be fake, I am willing to be fined a huge percentage of my net worth for the mistake that I made. This is essentially proof of stake. And it works differently from coin to coin. But usually the way it works is when they see a transaction validated, like in the case of Binance, puts a certain amount saying this transaction is, like, I checked it, it's real, and here's how much I'm willing to bet. And other validator looks at it and says it looks real as well, because this guy already bet this much, I'm willing to bet that much and a little bit more. And it kind of becomes like this game around the table where everybody keeps betting progressively higher amounts that the transaction is indeed real and that it needs to be approved. And once it gets to a certain threshold, it's considered real and the transaction is approved. The advantage of proof of stake is very simple. Unlike proof of work, which requires mining, which requires electricity, and is also time consuming, again, the sculptor having to make the statue, doesn't matter how good he is, he's going to take a lot of time. The validator with the proof of stake is more saying, I didn't have to spend any time to generate this cash. I just have it sitting in my bank account, and I'm essentially betting that everything is real. So there's no electricity costs, there's no time costs, so it can be done far faster than proof of work, which is why BNB is capable of processing far more transactions per second than the Ethereum network, like the Binance Smart Chain versus the Ethereum network. And there's the other proof of stake done with other methods like Coin Nano and everything. They use a slightly different with the third proof of stake. But in essence, they all come around the same part, which there's some sort of validated network. Some of the critics about this say that validated systems centralize things a little bit more, because now in the case of BNB, you have 21 validators and they can be compromised and such, while with miners, you have mining pools and such. But it's somewhat flawed argument in some cases, because technically mining pools of Ethereum, for example, 3 mining pools control more than 50% of all the hash rate. Sure, the mining pools themselves come from different miners contributing with individuals, but at the end of the day, you have one pool controlling like 20 or 30% of all hash rate, which can also cause its own issues of decentralization. In the case of Ethereum 2.0, this is not a problem at all, because you'll have tens of thousands of validators, and the network is far more decentralized than it would be with many other entities. Now, another question I had was, let's see, staking. Like, staking is becoming very, very popular. Like, PancakeSwap is a very popular one, but you have others as well, like Sushi in Ethereum, and you have also the decentralized lending markets like Aave and Venus, which is essentially staking. And the question becomes, how can you tell if you can lose money on them, if it's a scam or anything of the sort? So when it comes to swaps like Pancake, the only 2 things you need to look at is if they have what's called a migrator code, which is the ability for the devs to pull funds from the contracts themselves and transfer to other addresses. That code was originally designed to, in case something happens with the contract, the developers could migrate everybody's funds to solve the issue, etc., etc. But obviously, that can be used as an exploit. So the first question you should go is you go to a chat for that swap and you ask, is there any migrator code? And people should be able to tell you yes or no. And if it has migrator code, there's a probability you can lose your funds. Not necessarily mandatory, but for example, Cake still has migrator code, but they never use it and probably never will. But if it doesn't, then that reduces the probability of losing funds. The other part is time lock functions, which is if you have a swap that they need to maintain contract ownership because they need to change rewards, need to introduce new pools, etc. So they need to make contract changes. But usually they put those changes behind the time lock function, which means they broadcast the transaction, but then it only gets executed after a certain amount of time from being launched. That's what's called the time lock function. So if I send it now and the time lock is 12 hours, the transaction is only executed 12 hours from then. That allows people to check to make sure the transaction is real, it does what it's supposed to do, that the devs didn't make any mistakes, and nothing funky is happening. So if they have a good time lock function, that's also pretty safe, because any sort of mistake that gets broadcast or any sort of exploit, everybody will have 12 hours to figure out what it is and essentially dump the holdings or leave the project before the transaction was executed. With that said, there's other ways that swaps can potentially exploit you, particularly if you have the swap token. So if you're on Pancake and you own Cake, you have far higher chance of getting exploited by Pancake than if you only held BNB or BUSD, because they have a lot more options to manipulate the emission rate of their tokens and essentially do things that could cause tokens to come out of thin air. But they can't do that for BNB or BUSD, which is why when swaps rug pull, the token itself goes to nothing, like to zero immediately, but the other tokens they have in the staking pools, like BUSD and BNB, they actually don't change in value at all. And a lot of times people are able to recover their funds if they have them in those staking pools. But in essence, to know if you can stake in a swap, the questions you need to ask is, does it have a migrator function? Does it have a time lock function? And of course, how big is the project? Something the size of Cake is far less likely to deceive people at this size than a swap that shows up 10 days ago and offers like insane APRs. So always a thing to consider. Another question is, you many times said that you're bullish on BNB, and I saw the video about it, but what about regulatory aspects? So I am very, very bullish on Binance on the Binance token. I think it's the best token of the entire crypto system for large cap, no question. Better than Ethereum, better than even than Bitcoin, in my opinion. And the reason why I'm bullish on Binance is because they have the exchange, which is a positive cash flow generating business, generating ridiculous amounts of money to essentially support their ecosystem. Binance will be able to handle anything that gets thrown their way better than any other project in the entire ecosystem. Any regulatory challenges that show up with Binance, they have a much higher chance of surviving those challenges than Ethereum Foundation, for example. And they also made decisions in the beginning by burning all the team tokens and essentially never having sold a single Binance team token ever, to essentially guarantee that their token does not get qualified as a security, which avoids a lot of legal issues in the US and other countries as well. But in essence, being bullish on Binance is being bullish on the crypto market, on crypto as a whole. Any regulatory aspects that will affect, for example, Bitcoin, there are entities that will defend Bitcoin against regulatory, but nobody actually owns it. So that makes the effort a little bit better in some ways, but worse in others. But in terms of Binance, you have a company generating something like $50 to $60 million a day, being able to throw a lot of that money, even if not all of it, to defend its token in a bunch of regulatory environments. And they don't need to get all the big countries to agree that Binance is okay. They just need many small ones here and there to say that, yes, it's fine. We can have the BNB network and everything for the plan to already be properly executed. So in that sense, BNB is not going to go anywhere. In my opinion, it's the best token of the entire ecosystem. I think eventually we'll pass Ethereum. It's only a matter of time. It might take a few years, but it's going to happen. And I wouldn't even be surprised if it gets very, very close at some point to the Bitcoin pricing. And the reason also for that is we already have multiple examples with something like this happens where a company, and again, I have a video on this on YouTube for the Yummy Crypto channel that you can check, but companies that have a visionary leader with full dominance, with cash flow positive businesses, with a wide moat, meaning very hard to compete with them once established, they usually become the pinnacles of an industry. They become the foundational pillars of an industry, and they dictate so much of that industry that they become targets of regulation themselves with various degrees of success. And if you look at Microsoft, Facebook, Google, back in the day, Standard Oil from Rockefeller, those are all examples of companies exactly in the same position that Binance finds itself now. Visionary leader, they essentially the leader of the industry, or very close to being the leader of the industry. So much so, and they're starting to be so successful that they become victims of their own success and they attract regulatory scrutiny. That's exactly what's happening with Binance. But regardless of that, those companies move forward to succeed and become much, much bigger than they are today when those regulatory pressures started. If you look at Facebook, when they first started having issues with regulations, Facebook was about 1/15 of the market cap it is today when it started having its own issues with the law or with social networks in general. And now it's 15 times bigger. So Binance, in that sense, is just getting started. And I honestly think it's going to be the leading project moving forward. Now, going back to Yummy in particular, someone said, I think we have a lot of exposure in Yummy to the donations, to the donation streams, and a lot of people are now familiar with our efforts. But we need to start generating more utility to get people to buy the token and essentially incentivize to accumulate. Any plan on that? The answer is yes. That's why we introduced the growth fund. The growth fund is essentially going to be using a portion of the Yummy proceeds from wallet triggers and allocate them to high quality staking contracts, and then take any proceeds taken from those contracts, use them to buy Yummy on open market, and essentially burn them forever and bring back value to the holders. The fund will grow over time, and we have plans to dramatically accelerate the size of the fund. And the good news about the fund is, right now, the only way you have of eliminating Yummy circulation is the more volume you have, the more transactions you have, the more wallet triggers, which means the more Yummy gets converted into BNB, which then you can use that to buy back some of the Yummy and burn it. But obviously, if the volume slows down and everything, those mechanisms slow down with it. The fund kind of bypasses all of that, because if you have like $500,000 or $1 million in that fund, generating like $1,000 a day, which is totally possible with today's staking contracts, you can use those $1,000 a day to buy Yummy $1,000 and just burn it. And those $1,000 are independent of Yummy volume or price points. It's a constant buying pressure that could decrease if the market goes down or the staking contracts lose APR. But it's not dependent on the Yummy volume or price point. And that is a key differential, because right now, any activity in Yummy and every appreciation in the burn mechanism requires Yummy to be, having some sort of threshold in volume and a threshold in price point. But the growth fund ensures that even if we get to a point that the volume is very low, the price is very low, we still have that positive buying pressure no matter what. And that leads to the other question that people have, which is saying, well, the volume is slowing down in Yummy, like the transaction volume is low. What is the strategy here? And I say, well, the volume is lower, but it's not just Yummy as a whole. There are plenty of other projects, particularly ones who've been established for longer, who are seeing lower volumes now than they were 6 months ago. Some of them, volume drops of 90-95%, if not more. It's just like the nature of the market. Now, the difference that we have versus other projects or even versus a company is that we don't have running expenses, in the sense of we have some running expenses of maintaining some fees on a monthly basis, but they're small enough that the wallet triggers can cover that with no problem. So in essence, you're having like low volume is not really a problem. The problem is if you're having high volume, but the price is like collapsing, because that's where then your alternatives of how to deal with that are a problem. Right now, what the low volume tells me is that we've reached a point of equilibrium where a lot of people who know the project and holding the project are very convinced about it. They're like motivated. So there isn't a lot of sellers. And because the market is so fearful right now, and people are just now kind of dipping their toes again as Bitcoin starts to recover a bit and everything, the amount of buyers is also very limited. There aren't a lot of people nowadays, putting 50,000 or 100,000 in the project without doing like that much research. So what that tells me is we're a bit like in a standstill where not a lot of sellers, a lot of motivated holders who are just holding and see what's happening, and not a lot of buyers because of the status of the market. So that's a good place to be, because then you can survive this downturn or this environment without actually costing you any money. Sure, the volume is not moving much, and people might see that as being a little bit of a standstill, and then you have to go on chat and say, hey, what's up? We need news, we need developments. But this is not about getting hyped up every single day. Hype works well when you're in the bull market. It doesn't work very well when you're in a downturn. Like anybody who wants hyping of something, they're just looking for an exit point and never to touch the project again. And you simply cannot win in that kind of scenario. The way you win is by maintaining that status quo for as long as you can without spending any money, or as little as you can. And once you see the market turning positive and optimism changing, well, you have those sellers who are pretty holders who are pretty motivated, not selling much. But now you have a new pool of buyers in the market who are kind of looking for a deal. That's when you kind of shove in the marketing. That's when you shove in more activities for giveaways and everything to get the momentum going. And that's when you start really activating that part of the process. And if the downturn is prolonged, you have something like the growth fund generating a certain amount of money per day that you can use to buy back Yummy in the open market and then burn it. So that causes the growth fund is essentially a way of maintaining buying pressure when the market is bad, while the traditional mechanisms that exist in reflect tokens ensure that you have plenty of burning mechanisms and plenty of options when the volumes are good and when the market is looking good. So that is essentially, in a nutshell, the utility behind the growth fund is to essentially have it as an edge for the market not performing as well as you think it can, or just a hedge against potential downturns. And one of the rules about crypto is things can always go lower. That's one of the first rules of the market. Every time you think that things cannot dip any lower, they will. But the same way that they can go lower, they can also go a lot higher than you think. If you ask a year ago, people if Binance, if BNB would ever go from $15 to $600, probably almost nobody will told you that that's possible. But yet that's what happened in the space of like 6 months. So things can always go a little bit crazy. But we have a lot of plans at Yummy of how to maintain through the downturn and how to keep the tokenomics going. And again, low volumes are not a huge problem. You don't want to have things being hyped up all the time because hype is not going to get you far when you have a downturn market or when people are just not excited as a market as a whole. Because at the first sense of Bitcoin price dipping again or BNB price dipping again, and you have a large correction like you would in a downturn, again your volume will go down, hype will die, and then you have to again go through the motions of creating that hype once again. And while that is useful when you create with partnerships and everything, because it also helps your reputation, you have to be careful about using your bullets. You don't want to spend $50,000 to get a shout out from a celebrity on Twitter just to see that effort die out, which then takes a lot of win from the community. Like if we paid $100,000 to a mega celebrity to shout out on Twitter, and then if that didn't do anything for the price, and then the community will come back and say, okay, so now what? This didn't work. What are we going to do now? And all of a sudden, you're fighting all this uncertainty from people who thought that the single event was going to essentially deliver them like in some shape or form. Which is another thing to always pay attention to these is to never rely on a particular one single event to pump the price. It can happen, but might not happen, particularly if it's a downturn market. Of course, if you have a truly alpha event like Ronaldo gave us giving us a 5-minute video to buy Yummy or something, of course that would move the price because it would be such an extraordinary event. But other things are most likely not going to do much, or at least not as much as you think. So trying to focus on issues of getting out of a funk and improving volume in the short term is most likely not going to work. So you just have to kind of ride and be patient and just kind of have a strategy to deal with a prolonged downturn, which is what we're doing in case it happens. But if Bitcoin starts improving and things again look rosy, you have plenty of strategies to address that as well. Now, another question people have about Yummy is they heard me talking on Telegram about an updated or upgraded Yummy contract at some point in the future. First off, I just want to preface this that this is purely speculative. At this point, we're just kind of throwing some ideas around. And Yummy Tokenomics as a whole, they're very good, but they can be improved. One in particular is the automatic liquidity increase is a little bit too generous. While the automatic liquidity increase is excellent when the project is doing really good and prices are going up because it provides stability in pricing, it provides a much more uniform pump, if you will, or make it a lot higher probability of holding steady. It can actually work against you through prolonged downturns or if the price is very low, because it also makes you more stable around a particular price point. The advantage of a liquidity pool, though, is that in essence, it acts a little bit as a piggy bank. So if I have very high liquidity and my market cap is low, and let's say I have 20% of my market cap in liquidity, I essentially have 15% of market cap in actual funds, cash funds, that are not really doing anything. And I could remove that liquidity, still have 5%, which is perfectly fine, still more than enough to have a project going, and then take that 15% and put it in the growth fund or anything of the sort, or buy back tokens or whatever. But because we have renounced contract, we can't do that. We can't tap the liquidity is locked, the contract is renounced, we can't remove the liquidity. But if we did a contract upgrade where people change the tokens, and it will be like a very smooth process for the user, you just have to send your tokens to one address and you get Yummy V2 back, basically. We will be able to tap into that liquidity and then readjust the automatic liquidity bill to something more reasonable. Instead of 3%, have it maybe like 1%, and the remaining 2% could be manual, because sometimes you want to add liquidity, but sometimes you want to buy back tokens. Added liquidity flat out, no matter what, is something that can hurt you in some stages like we are now. Although it's a good idea because essentially, again, you're building that piggy bank, but it can make you a bit more stagnant. But if we did a contract upgrade, we can tap the liquidity, we can change the automatic liquidity build, and it will just give us so many more options to essentially unlock value. And in the case of Yummy, we could do this in a way that we will get about $600,000 to $700,000 back in liquidity. We put that into the growth fund. That generates about $800 to $1,000 a day in Yummy, in income that we use to buy back Yummy. So now we introduce the mechanism that burns $1,000 in Yummy every day with literally like no effort. And we reduce the liquidity enough that now any decent sized buy actually moves the price a decent amount, not insane amount, but a decent amount. So when people buy and everything and volumes increases, you actually see a much more like of a price movement than you would now. Because right now in Yummy, it's truly incredible how you can sell or buy $100,000 worth of Yummy and you move the price like 6% with the liquidity that we have. Very, very stable for a big investor. That's very attractive because they can put a lot of money and not move the price that much. But it also guarantees it takes that much more capital to move the project. So advantages and disadvantages. But by doing a V2, that would allow us to tap into that liquidity, introduces additional funds, an additional funding mechanism that, again, will not be dependent on Yummy price or Yummy volume, reduce the liquidity, then makes it easier for the market to actually showcase like when things are moving up. So that is the main reason behind it. But at this point, it's only being conceptual, and we have plans of how that transition will happen. And for the users, will be super smooth. Like you send your tokens, and then you get back tokens V2. Trading will be halted for like maybe a day or two at most, and then liquidity will be added, and boom, people will be able to trade. And because relaunches, or this is not even a relaunch, this will be like a transfer, can be pretty bullish events when done right, and when done in strength, and when done with proper communication and everything. I honestly think it could be a real interesting event because it will unlock us with so many other possibilities. And you get good communication from the community, you get input from everybody, and then it's like a fresh start of a sort. But obviously holders won't lose any money, there won't be any additional funds being committed or anything of the sort. The other advantage that you have is that by changing to a different contract, and you provide incentives for people to migrate the tokens early, you give them a percentage or something. But there's always going to be people, for example, who are never going to migrate, because this crash, it's estimated that about 20% of people that were in crypto 6 months ago are no longer in crypto. Why? Because they lost everything, or they just got disenchanted, or they bought at all-time highs, or whatever. They abandoned crypto as a whole. So that means we can have as much as like 10% or 20% of Yummy, if you go by that, which are in wallets of people who are never going to use them again, or don't care, or simply not going to do anything. So those people will never send their tokens to the contract, so they will never like migrate to the new one. So those funds will be reverted back to the team, and they can be used to be burned, or they can be used for other additional parts, for liquidity or whatever it is. Essentially, you're capitalizing on the fact that you had a major downturn, and you had a lot of people capitulating and essentially leaving the markets. But sometimes they might have owned so little Yummy that they didn't care about selling it, or they might have lost the keys, or they might not even care. They might have had $200 worth of Yummy, and now that's like $40 or $30, so they don't care. They didn't sell anything. You captured all that value back to the team, and then you can burn it, which benefits all the holders, or you can add it to liquidity, which again benefits all the holders. And what you sacrifice is all these other people that kind of bought when the hype was high, when the market was good, and now decided to abandon it, and they don't care anymore. And I think that in case of Yummy, I wouldn't be surprised if there's like 10 to 20 billion Yummies, meaning like 1 to 2% of all Yummies, that are in that situation. That once we finalize with the migration and give plenty of time for people to migrate, like a year or something like that, that you would, even at the end of that year, you will have 2 to 3% of Yummies that were never claimed. And then it could be burned to the benefit of the community. So there's a lot of things that can be done about it. And the other aspect is, by going to a new contract, you can revamp the tokenomics a little bit, particularly, again, around the liquidity, and also introducing other mechanisms that exist in other tokens, if you want, with the buyback mechanisms like the Kraken, although the efficiency of them is somewhat disputed, because algorithmic buying versus manual buying is really not that much different in terms of efficiency. And actually, you're better off the taxes you receive not to even sell them back into BNB, but to just flat out burn them without having to do sell, then a buyback. So there's different discussion in the field about it, but that's something that we could debate if we get to a point of doing a relaunch. So in essence, there's advantages in upgrading the contract, moving to a different version. It's something that could have benefits, but right now we're just conceptualizing, and there's no timeline for it or anything of the sort, but it's definitely something that the team is thinking about. Now, for another question was about NFTs and the deals we have with the NCAA basketball team and other upcoming deals. NCAA, so for those who don't know, we signed a deal with the Miami Hurricanes to essentially sponsor the entire team for a fixed amount of time, and we essentially pay them monthly, and they're going to do Twitter shout-outs and stuff of the sort for social media engagement and posts that we're going to give them. This deal starts in September. We're very happy about it because we're the first crypto project to take advantage of the change in the NCAA guidelines for those who are not American, for the National College Association of essentially college sports. And what they essentially enabled is the ability for people to sponsor college sports teams, which in the US are huge. In some cases, they're even bigger than the professional teams themselves. And allowed to sponsor the players to have their likeness or their imaging and essentially use their name for whatever business venture you have in mind. So they can tweet about us and everything, and they have contractual obligations of things to do. One of the things we can definitely do, and we're working very much into it, is creating NFTs from those players. Well, we can't use the labeling from the school itself. We can't say Miami Hurricanes or whatever other school we have. We can certainly use the name of the player and the face of the player and create an NFT around that, and even put the Yummy crypto labeling in it or whatever you want to do, and essentially sell those at market. If you happen to hit a team, and the team we have is very good, and if there's potential that it gets to playoffs or March Madness or anything, obviously the interest in the players rises exponentially, because then people will start talking about the probability of them going to the NBA and all that kind of stuff, and the value of the NFTs can rise with it. So that would make it even more engaging. So yes, to answer the question, totally possible to create NFTs out of the NCAA deal, and it's something we're very much looking into do it in the future. Now let's see if we have still another question. Final question was, what is leveraged yield farming and what are the risks? Well, leveraged yield farming is becoming now very popular, and one project that does it is the Alpaca, is one of the swaps that does that in the Binance network. And essentially, like the name says, you stake the funds and you use some of the tokens that you get to lend into a decentralized market like Venus, and they get additional funds and then create additional staking. And some of these algorithms are doing that for you, and you're essentially leveraging yourself by providing some form of collateral. The disadvantage with that, very much like lending, traditional lending, in some ways, this is no different than you, again, in the first example, you lend out 100K in Bitcoin, and then you would get, Binance and BUSD or whatever, create an LP token on Cake, and then stake that on Cake. In essence, you're doing a little bit also using collateral to create a staking contract. The leveraging is a little bit different, that in essence, it works a little bit like a futures contract. So in the futures contract, if you leverage 10 times, you can say, I buy Bitcoin 10% with 10 times leverage. That means that a 10% movement down will wipe you out. If you did 100 times leverage, that means that a 1% movement downward from your entry position would wipe you out. Not considering the other costs of funding and fees that exchange charges you to provide that service. So the more leverage you have, the less cushion you have for a downturn, right? But of course, the leverage goes both ways. If I have a 1% move down, 100% of my position is wiped out. If I have a 1% move up, I gain 100% return on my investment. So I essentially double it. And that's why futures, again, with liquidations and all this kind of stuff of getting to a point that you're getting wiped out, can become such a domino game, especially when the market is so frothy, so up there, because people start getting liquidated, and then that causes market sells, so more liquidations, etc. Leverage staking is exactly the same thing, with the difference that instead of your funds being used just for like borrowing or something, they're being used in a staking contract. At the end of the day, it just translates into more risk. That's always what it comes down to. If you want an absolute, well, I can't say absolute fail-safe mechanism, but very, very safe way of making some very, very good yields is you take $100,000 or whatever amount you have, convert that into USDT, which is Tether, or BUSD, which is the stable Binance coin, and you put that in a staking contract on Cake, on Venus, or you can put on Venus the full 100,000 and then borrow any other token that you have, like you can even mint their own token because the yields for them are like very, very low. And then you can put that token, also a stable token itself, in a staking contract in Cake and generate yield. Or you can create an LP, for example, BUSD to USDT. So essentially you have two tokens. They're both stable coins. They're both pegged to the dollar, like 1-to-1. You create an LP and you stake that LP into Cake. And right now that gives you like 15% yield or something like that, or 16%. That is as low risk as you can possibly get when it comes to yields, and you're still getting 15%, which I know in crypto doesn't sound like much, but in the real world is a ridiculous amount of money. And this is one of the things that people need to like start understanding is, while in crypto you pay a huge premium to really go after the things that can 10x and 100x your money, and they're out there, there are projects that can do that, you need to start focusing more in things that give you 10%, 20%, 30%, but have almost no chance or very low risk of losing money. And there are many, many out there, especially in swaps, small swaps with no migrated code and everything, where you can put $10,000 yielding 30% a year, and you have a very low chance of losing capital. Very, very low. Unless the entire protocol, like the Binance network, goes out or something crazy that happens. Like even if the website that provides you, the swap provides you that service, if the contract has an emergency withdrawal function and everything, you can still pull out your funds even if the swap disappears entirely, as long as the network still exists. So in essence, you're betting on the fact that Binance Smart Chain will continue to exist. And you can get 20-30% yields, which is insanity. Like no financial advisor in stocks or anything would promise you 30 to 20% yield on anything. And here you can get it with very, very low risk. And why is that the case? Because 90+% of crypto investors are taking so many chances and they're putting themselves in so much risk that the guys who are moving away from that and just playing it safe are reaping the rewards from that risk by lending to people who have very risky behavior. They themselves are making a lot of money. In essence, it's like payday loans and other things where people pay super high interest rates. You essentially helping people, taking chances and having insane amounts of risk, and you're getting paid for that in very, very generous terms, in a way that the algorithm is so well designed that it protects you so well that the probability of you losing money is very low. Like if you actually lent out money to someone in the actual world, like physically, you'll have to be concerned about getting paid back. But here, the algorithm does all that work for you through the use of collaterals. And in essence, it almost never gets to an instance that you actually lose money. This is the insanity of crypto, is that if you actually have $10,000, $20,000 and you play it safe, you can like increase that amount by 20 to 30% a year in a very realistic, safe way. And that is insane. That's something that the current financial markets can't even touch. You try putting this on a savings account, you get 0.8% or 0.7 or 1 or whatever it is. Even in the stock market, you will get something like 5 to 10% depending on the long-term growth. But this is 20% on stable assets that will not change in value. The principal will not be lost. The only thing you are assuming as far as risk is concerned is the destruction of the protocol or the destruction of the network as a whole, which I personally think is never going to happen. So in that sense, staking pretty much any big swap like Cake, any other swap without migrated code like Ape Swap is another good example of a medium-sized swap that offers good yields, no migrated code, good time lock functions, and a pretty good team. But there are a few other ones out there as well. The only questions you need to ask is migrated code and time lock, and you can enjoy some really like reasonable yields on whatever principal you have without that much risk in the loss of capital. And I think we hit the 1 hour mark. And that's also the end of all the other questions. My voice is dying out a little bit, but I can still answer a few more. So if anybody has any questions, just let me know.
All right. Thank you for all that talking, Joe. You did a great job. I'll pull out any questions if I identify some in my DMs. If you have any questions you'd like to ask before, maybe we'll take one or two before we close everything up here. Feel free to DM me or raise your hand using the the audience feature, and I will add you to the live stage, and you can ask your question vocally, or feel free to PM me via text. I have a question in chat, Joe.
Yeah, go ahead.
If Yummy V2 happens and the liquidity opens up for us to extract for growth fund, etc., how does this look to external investors for rug pull risks, etc.?
Yeah, so the liquidity will never be open. It's not like it can be pulled. The way that the liquidity will be extracted will be you tell people, okay, transfer the Yummy V1 to this contract address. You get Yummy V2 back. You can't trade it yet because there's no liquidity, or you have a function preventing the trade for like 1 or 2 days. And then you accumulate V1 in this particular contract. And once you hit a certain point, like let's say 100 or 200 billion, you would then say, okay, we're going to drain the liquidity now, which essentially means we're going to sell Yummy V1 at market, and that will cause the price to drop, of course, but then you're pulling the BNB out of the liquidity pool. You're essentially putting Yummy V1 there and putting V2 and putting BNB back. But as you do this, you would open up the trading of V2, supply liquidity to the V2 contract, and now trading can resume. And then people will start trading in the new contract, and trading in the first one would still continue, but it would really reduce because the majority of people at that point will already be transferred to V2. You would still have a lot of people with V1 tokens, and they will look and they say, wow, price crashed, whatever. And that could cause some FUD in the meantime until they come on Telegram and they understand what's happening. Obviously, we have to put messages on the site, on the Twitter, on the Instagram saying we're doing a contract transfer right now. So don't trust the price you see. We also will contact the exchange like Bitmod and saying there's going to be a contract migration. You guys need to send us your tokens or send your V2, but please stop trading this day and this day. And this is all stuff that's been done before. Like this is not, in some ways, not rocket science in the sense of how this process works. We simply have to do a little bit differently because since we have contract renounced, we can't automatically pull the liquidity from the contract because it's locked, and that's a good thing. But we can still get enough V1 tokens that we will sell them at market and then get the BNB back. Now, some people might see the price drop and then decide that this is all very funky. They don't want to do anything. They just sell the V1 at a huge discount because we already pulled the liquidity. Now it's very low, so they're losing a lot of money if they do so. But the way for them to make the most money is to send us the V1, and then we send them the V2 back as we go through this over time. If they decide not to do that, then the team essentially holds the percentage of the tokens, which would then be burned to favor the entire community. So if you have the people who decided to abandon the project and never looked at Yummy anymore, you capture those tokens. If you get the people who also don't see the benefits of a contract upgrade and decide they don't want to do this anymore, they essentially would lose 80 to 90% of their tokens by deciding not to convert. If they converted to V2 and then sold V2, they'll be fine. But if they decided not to convert, then we would gain huge value from that decision. So in essence, all steps here would favor existing holders and anybody who would buy V1 at any time versus the people who simply don't care about the project anymore or just don't even look at it or have such little Yummy they don't care. But at no stage there would be a possibility for anybody to do a rug pull on the liquidity. Like you would extract the liquidity by selling Yummy like you do normally. And you do that by convincing the community to send you their Yummy to then extract the BNB, which again, this only works when you have community behind it, everybody agreeing that this is a good thing to do. You talk with, the big holders and you tell them, hey, are you on board? Are you on board? And you get, on paper, a certain consensus that, let's say, 30% of all circulating tokens, at least, are like, yeah, we would do this. And then you're like, okay, if you get 30% consensus, we can try to find the remaining 20%, but we know that this is going to happen. And that's why community votes and all that will become so important, because that's the only way that these things would actually happen. But then the benefits of an upgrade with improved tokenomics are so large that they far outpace like this slight, transition that would last for like a week at most, like of instability, if you want to call it. Like it'll be 2 days of pretty crazy developments, but then it will start getting a lot better. And there will be a very, very high probability that when you convert to V2 and you open up the liquidity, because now it's much lower, the worst has passed, people have converted, the future is bright, V2 is coming, that you actually have a price appreciation, and that you will have actually V2 opening like 50 or 60% higher than V1 because people would see it as a bullish event. And if that happens, then who knows what could happen? Then you can have the V2 going crazy while you're emptying the liquidity of V1 and transferring it to V2, and then you could have a really sustainable movement. But at no point, to answer the original question, is the liquidity at risk of getting rug pulled. It simply can't happen.
Okay, so we have 3 more questions, and I think we'll wrap it up there. Maybe try and keep the answers quite concise because we're running a bit over now, but it's all good. So next question is from Boritintin. He's got sort of a two-sided question. He says, 1, as far as utility, what kinds is Yummy looking at? What will motivate people to use Yummy day to day versus just holding? And then 2, where can one learn more about staking and high yields, which you mentioned with BNB, USDT, etc.?
Learning about staking and high yields, a lot of YouTube videos about it. There's a lot of content you can check on various swap Reddits and such. You can learn a lot about the various contracts. I mean, you just really have to Google and start reading everything you see about the staking itself. The 2 big things you only need to know about staking, like I said, especially in the swap, is you go on their chat and you ask, do you guys have migrator code? And what is the time lock function? Like, what does it say? Is there a time lock function? If it's a no, if it's a yes that they have migrator code and it's a no, they don't have a time lock, then just don't do it because the probability of exploit is super high. And more resources, you can just Google and you'll find plenty of people just talking about staking. You just need to read more about it. And the second question is, or the first question was about the utility of Yummy. And yes, utility is important. So right now, the utility has the aspect of like the reflex themselves, which is not really much to be said at this point. But we do have the introduction of the NFTs. We have also the use of the merchandise, of people buying merchandise, which we just had a few messages today about the new things that are coming, like mugs and stickers and hoodies and everything. All that to be paid in Yummy. We also have the game with Slam Crash, which has been a huge success. It's now really starting to pick up and people are using it and playing a little bit. Of course, it's still like a game. It has utility in that sense because it consumes Yummy just by the game itself, but just the transfers to the wallet also consume Yummy. And Slam has done a really good job with the interface and with the game itself, pretty entertaining, and that's also additional utility. Other part would be the burning the growth fund, which would burn Yummy. It's not utility per se, although we are going to have a function where people can submit Yummy to the growth fund and get a percentage of the returns of the fund instead of being burned to go allocated to them, depending on the amount of Yummy they contribute. So that will provide with kind of our own internal staking contract. And we also have the whole NFT stuff with NCAA and everything, where any profits coming from NFTs, or even trying to see if we can do a system where we will create a market where people have to buy NFTs using Yummy, although that might be a little bit more complicated. But certainly can get to a point of using the proceeds from NFT sales to buy back Yummy at the market and essentially burn it. And utility, like if you do staking contracts where you provide people something for them to stake Yummy and get a return, or if you find a way of generating cash flow, which then generates a buyback and burn, that's really the 2 forms of utility that you want. Is you want incentives to hold, which the biggest incentive to hold is people think the price is going to go up. And the other utility is you want a mechanism that burns Yummy, preferably independent of Yummy price and volume. It's something independent that just keeps burning every day. And that's essentially what the growth fund is. And we have other ideas as well. But those are the other ones who are the most solid right now at this stage, and that will definitely happen.
Okay, so last 2 questions. We have one from Tucker. He says, question for Joe, how are the returns so high when staking? Quite simple question.
So usually the returns are directly proportional to the circulating supply of the token that underlies the swap. So like Cake right now is a really, really monster of a project. It's huge. So the inflation of Cake, while still high, is not as comparable as a token that just launched. So for example, if I have a token that launched yesterday, their inflation is probably in the range of 100 to 200% a day. So the APRs of those projects will be orders of magnitude higher. They will be like 700, 800, 1,000, even more than the inflation rate of the token. But if the project is successful and the value locked in the project increases and it becomes more popular, the APRs will start decreasing because the circulating supply of the token increases and the percentage of the inflation that is happening is never as high as it was in the beginning. Now, if a swap is truly successful, like Cake, they start getting a point where they have so much utility that they start buying back some of the tokens that are emitting on a regular basis, and then they burn them to such high degree that the inflation is kept lower, or ideally even stable, or even crazy it will be if it starts deflating. No swap, including Cake, is stable. They all have inflationary pressure. They all still inflate more tokens than they burn. But Cake is definitely getting better, as are others. So the reason why they offer you so much high returns is directly proportional to the how long has the swap been around and how much funds are actually in the swap. The less funds are committed and the younger the swap, obviously the more risk it can be, particularly if you use their own swap tokens. But I argue that if you have a swap that has no migrated code and has good time lock feature, and you don't invest in their specific token, they actually are very safe. For example, there was a known swap back in the day called Ice Cream Swap, which didn't have migrated code and it had time lock function, but they got exploited. And the exploit was someone changed the contract to change the emission rate of ice cream, which was their or cream, which was like their token. And essentially the contract just minted millions of tokens in seconds, and this guy sold them at market and essentially crashed the token price. And at the time I had staking in that swap, but I only had USDT and BUSD stablecoins paired, and they were yielding, I think it was like 300% or 400% a year at the time, whatever. Because they didn't have any migrated code and they had time lock function, I was able to take the principal back using their website because the website was still functioning and everything. I took the principal back. I didn't lose a cent with Ice Cream Swap exploit, while other people who had Ice Cream lost tons, like lost essentially 100% of principal, because when they crashed with millions of tokens. Now, the devs claimed they were hacked and they claimed that there were issues, and I believe them. They actually stuck around and they launched the V2, which also wasn't successful. But if you only staked non-swap coins in a swap that was literally a week old, giving you insane returns, the risk was actually very close to zero. I would even argue that for a knowledgeable investor, it was zero. Like, even if their website was down, and even if they closed the Telegram, even if they did all that, even if it was a pure scam, I could still go into BSC scan and use the emergency withdrawal function to pull out the LP and pull out the BUSD and the BNB and USDT that I had in the contracts and recovered all my principal. Plus, whatever ice cream that I had accumulated at the time and sold, because I would usually stake, when I stake, I sell every day, basically, or every few, depending on the yields. I will get those rewards. Those will be mine because they're already converted to other currencies. So if you have those kinds of contracts with migrate and everything, that's how you assess the security. But to answer the original question, usually the younger the swap is and the more funky it is, the higher the risk. If it starts having kind of crazy things, and of course, investing in the token of the swap itself is by far the riskiest thing, because if they have ways of minting additional tokens or something else hidden in the contract, they obviously can exploit.
Okay, we have the very last question here. I think, yes, this will limit that number of questions. So we've got Gibbs asking, so firstly, would we have the same total supply on V2? And secondly, would V2 potentially be able to burn the total supply more swiftly, and therefore a price of 1 cent or even 10 cents could be more realistic in a shorter period of time?
Yeah, I think V2, honestly, the reason why I'm always talking about it, though not always, but like starting to brainstorm, is because I think it will be extremely bullish. Because The answer is yes on both cases, and twofold. First off, whatever amount in the burn address on V1, when we generate V2, we would send the same amount to the burn address. So if we have 350 billion in the burn, we will have 350 billion in V2 right from the get-go, just from the start. That's number one. Number two is, again, you have funds of people that would never convert to V2 because they simply don't care or they don't want to go through the hassle. So they will just sell, take whatever loss. Or you have those people who, some of them will not even be in crypto space anymore, never converting. So that means you will end up with an additional 20 or 30 billion Yummy that nobody ever claimed. Now, of course, you'll make a generous claiming schedule. You say to people, you have 1 year to convert, right? If you send Yummy V1 to the contract, you get Yummy V2, you have 1 year to do this. And that V2, like, that does not get claimed, then we go to the community and say, okay, guys, we got 20 billion or we got 30 billion Yummies. Nobody ever claimed them. What do we do? And we say, burn them, sell them, what? And I think 99% of people say burn everything. So you just took 30 billion or so and boom, and you burn it all into the dead address. So you just dramatically accelerate. Now, because the dead address is a reflect token of its own, reflect address, the fact you sent so many now again increases the burn rate by a huge factor, because you essentially just increase the number of burn tokens by 10 or 15% in like relatively short amount. And in the meantime, because again, you already did the conversion to V2, those unclaimed 20 and 30 billion throughout that year will be receiving reflects of its own, right? So even if you start with 20 or 30 unclaimed Yummy, like 20 or 30 billion, you actually will have much, much more than that at the end of the claim period. And it will essentially easily be the biggest burn ever that we would ever do. And in the meantime, you created a growth fund, or you expanded the growth fund size dramatically, and you still have the regular tokenomics doing its own burn, right? So it really is a good way of capitalizing on the downturn of the market while still keeping the tokenomics intact, what works, improving what doesn't or what could be improved, and provide a good way of accelerating the burns and essentially like have this entire dust of Yummy in other people's wallets that's never going to go anywhere. It's not going to do anything. And for all intents and purposes, it's kind of already burned, but we just don't see it because it's spread through a wide variety of wallets of people who are no longer in the market. And you capitalize on that as well. Plus, I think we reached a point where we already showcased to a lot of investors and everything that was serious, that we spend the money like, in the charities, we did the live stream donations, we did everything, that more serious investors with the liquidity still being good, and then us having the growth fund, which is something that pretty much anybody who has a large stake in Yummy has DM'd me at some point or another saying that growth fund is an amazing idea, that they think it's like really one of the best developments, as I think that they would, which is why I created it. And if the growth fund all of a sudden became $500,000 or $800,000 overnight, or within the space of a month or so, that would be extremely attractive to big investors. I know that for a fact. And it would just change the discussion of utility completely. So yeah, I think Yummy V2 is something that we're still seriously considering, and there's a good chance it will happen. But if it does, what I can promise is excellent communication with everybody of all the steps. And most likely the only step you have to do is to send your Yummy to a contract address and you get Yummy V2 back. And most likely there will be some sort of incentive for you. Like, if you did this the first day that the contract is created, you get a bonus. If you do on the second day, you get, half the bonus. If you do on the third day, you get no bonus. And if you do any day after that, you get just whatever you sent. And of course, that will be like pre-tax amounts and all. Like, it'll just be easy, and there will be incentives for that. And once we empty the liquidity or something, we will just say, hey, we're about to do this transfer contract. You'll be able to trade V2 within 2 hours or something. Let's go. And I think it will be good. Now, because the contract is announced, so a bit different than just outright changing the contract and do whatever, but that's the cost we paid for trust and getting people to understand what was being done here. And now we can use that to leverage into the next step and really tap into our best asset, which is the liquidity.
All right. Thank you for your help here, Joe. I think we'll call it a day here. We've been about an hour and 20 minutes. It's been a great AMA, lots of insightful information. If you guys have any suggestions for future events, types of giveaways, more AMAs, whatever you guys want to see, feel free to leave a comment in event suggestions or just in general chat or RPMs. If you have any specific unanswered questions, feel free to ask them in general chat and we can always forward them. And thank you everyone for coming. And hopefully we'll be doing more events soon.
Yeah, and also, like I said, guys, this is the first step for the Discord engagement part. We're definitely going to do a lot more of these, and we have a lot of giveaways on Discord and a lot of other activities. Like, we grew so quickly on the Discord server, 20,000 members, and we're definitely going to start paying more attention, also hit the community and everything, many, many forms of engagement. So thanks everybody for tuning in, and I'll post this on YouTube and talk to you guys later.